Okay, it's 2:00, so I suggest that we start. So welcome to the May seminar of the GLO virtual seminar series. Today we are very happy to have Jim Bain here from the University of Leiden to present a paper on household spending over the life cycle. Jim, the floor is yours. If for people who are attending, if you have a question, please just jump in and ask the question directly. I think this works best, and Jim is happy to take questions along the presentation.
Absolutely. So thank you very much for, first of all, the invitation, Viola, and second of all, the kind introduction. And let me repeat that I'm happy to take questions along the way. So unfortunately, I cannot see you in this Zoom meeting. So feel free to break in through microphone and otherwise through chat, and Viola will give me a heads up. Well, as you can see, this is work with other usual suspects, I would say, from the NetSpar network, which is a network on savings, pensions, aging, and retirement in the Netherlands. Viola is also part of it. Actually, we're working on a project, but this is a different project where we had a small grant on. And this grant actually started not so much from us, the academic partners, but actually from the more practical partners, and more specifically from a pension fund. And I'll explain a little bit more about that, why this is of specific interest to them. Anyway, I will talk about household spending today, and especially household spending, how it has developed over the life cycle. And very specifically, we want to have a focus on a specific part of the life cycle, namely retirement. So there's a lot of literature, of course, showing that there might be or might not be a discontinuity in spending at retirement. Whether that is a consumption puzzle or not is kind of debunked in the literature already. But what is less so the case is that there's not many research that actually analyzes to what extent consumption develops over or through retirement. So that is something that we could do with, I think, very nice Dutch data. But let me introduce the topic a bit more extensively to you. So I think that there's lots and lots of papers that are very interesting related to the life cycle model, to pension and retirement savings adequacy. But I think that most of these papers, including our own work, basically, is much of it is based on observed income and assets. Firstly, of course, we have survey data on income and assets, and since a couple of years, we've of course moved to somewhat more administrative data. In the Netherlands is a good example of that. We have great administrative data of both income and assets. But the one thing that lacks in these analyses is, of course, what happens with the income and assets. So how does consumption develop over the life cycle, and particularly during retirement? So here we take a slightly different angle, an angle that has been studied before, but I think it was studied in different contexts and with different data sets that might be a bit, well, inferior to what we try to do, at least. And I think that the framework of the Netherlands, so we use Dutch list data, is very valuable for this type of analysis, because we already know, given the admin data, that income and assets that they provide, on average at least, quite some adequate retirement savings. So now we can study what drives this consumption behavior, because we already know that any decreases of consumption throughout retirement might not be related to having an inadequate pension, but instead it might be a bit more preference related. So we try to dig into that, and of course it's all about, well, not having great possessions in a sense, but having few ones. So we really try to see, using revealed preference data, what could explain, what types of preferences could explain these dynamics we see in consumption behavior over the life cycle. Well, I already started out explaining that this is quite policy relevant. So we knew that there's consumption data. We've used it before, but we thought that this topic dried up a bit, in the sense that, okay, we already say again. think there's a question or not. No. Okay, good. So let me try to motivate it policy-wise. So at some point, one of the pension funds came to us, and they're very much busy, especially with the new pension law, in helping people making the right decisions. And all the so-called choice architecture has become more and more important. And at some point, one of the persons from one of these pension funds came to us and asked us, okay, do we have any information on how consumption develops over, first of all, over the life cycle, depending on, say, for example, widowhood, but also divorce, etc. These are very important for pension funds because there might be some partner pension involved. But the main interest of the pension funds is, of course, in a broader sense, taking a look at this choice architecture, and especially the annuity schemes that they can offer to their clients. Well, two of them are really important. That is, of course, most of the pension funds have the default of having a flat rate annuity. But this might be inconsistent, of course, if consumption is not flat rate over retirement. So there are some choice possibilities that pension funds allow their clients to have, which is what we call high-low pension. So you start out high, and it decreases over time, which might be more relevant when consumption decreases over retirement. So that is something that pension funds can promote, or maybe even use as a default if that is interesting for their clients. So this is very particular to the different pension funds, and some already do this, but many of them don't. And the other thing is that, which is more generally discussed in policy right now, is next to the transition to the new pension system. There's the idea of allowing people to have a lump sum takeout of their occupational pensions at retirement. So we've been discussing this for quite some years already, and I think that's a couple of months ago there was a decision that we postpone it for another couple of years again. But the idea is very simple. Namely, the idea is to take out 10% of as a lump sum out of retirement, and I think some neighboring countries have already tried this, and I think the UK might be a very good example. I don't think that they use this 10% exactly, but I think 20%. So we were all afraid that people would start buying Lamborghinis. I think that the evidence shows differently, but at least it's another way to at least relieve some of the liquidity constraints maybe in retirement. So this is a very interesting option, but since we have not tried it yet, we don't know what would happen. And of course, this is very much related to the preferences regarding consumption. So this is, in terms of policy motivation for pension funds, really important because of the pension payout phase. So it's really crucial to understand how these expenditures develop and what the actual mechanisms are, and can we make sure that policy matches these preferences optimally. Well, of course, this is all embedded in life cycle theory, and if we have the most canonical example of life cycle theory, the life cycle model without any uncertainty, no bequest motive, rational expectations, etc., etc., then you would say that that households save during their working life, they save during retirement, and at the same time, it predicts what consumption more or less should do, which is that households will smooth not so much consumption itself, but the marginal utility of consumption over time. Well, we will see whether, or we'll try to pinpoint some preferences, some characteristics of households that might change this marginal utility of consumption over time. Which might then also lead to different expenditure behavior. And it's also good to mention here, and I think I will mention this on one of my next slides, is actually that we're not trying to be causal in this paper. So what we really try to do is to integrate all these different aspects that might have an effect on the dynamics of expenditure behavior over the life cycle, and in particular during retirement. But what we really try to do is let the empirics speak for themselves, and then do some kind of a backwards induction in trying to see what type of life cycle model, or at least what types of aspects and preferences and parameters should be in this life cycle model to actually match what we empirically see. Well, to do that, of course, it's also very good to at least have some idea of what we already know about the Netherlands and the pension adequacy that I already discussed a bit with you. There's absolutely no evidence whatsoever that on average pensions are inadequate in the Netherlands. So there are different people, the papers coming from different perspectives here. So one focuses on wealth, the other somewhat more on consumption, using the actual same data that we use. Others try to look at income and replacement rates, etc. But I think it's good to see here is that the main message from all of this evidence that we have in the Netherlands is especially that we just have quite high pension adequacy in the Netherlands. So if you take have an international look, let's say the Mercer Global Pension Index, for what it's worth, we've been consistently number 1 or number 2 if Iceland tops us. But anyway, on average, we have quite the high pension adequacy. So bear this in mind when we go through our empirics later on in the presentation. And there are some other institutional issues or issues, more characteristics that we have to bear in mind, because I think the Netherlands is a very particular country with a very particular structure in their pension system, which leaves us to believe that on average it is truly adequate, the pension income that households receive. And first of all, it's good to know that we have a combination of what we call 3 pillars, so state pensions, occupational pensions, and private voluntary pensions. And it's good to know that if you would sum all of the wealth that has been accumulated over the life cycle up to retirement, including housing wealth, etc., then the state pension and the occupational pensions are about 2/3 of all the potential income available. So this means that state pensions, occupational pensions are really important. They're about equal in size in terms of how important they are in contributing to the adequacy. And it's good to know that the state pension, of course, in the Netherlands has a universal coverage. It's independent of work history. It just depends on the number of years you've been in the Netherlands, which is slightly different for occupational pensions. Of course, this is dependent on work history. But be aware of the fact that occupational pensions are mandatory in the Netherlands. So there's a coverage of about 90%, even slightly more than 90% of at least paid employed workers, which means that many people actually also have some pension coming from occupational pensions. As a consequence,
sorry to interrupt you. I have a small question. So,
yeah, sure.
Is there any mandated retirement age? I mean, do they have to retire, or do you have any differences in public sector and the private sector as far as?
No, it's all the same. So we have a full retirement age that is used both in the state pension as well as in the occupational pensions. However, there is some flexibility in some pension funds to say, okay, there is flexible retirement is possible, or say partial retirement is possible. But in essence, to claim full benefits, both state pensions and occupational pensions use the same full retirement age in that sense. I hope this answers your question.
So is it an age number, like what, 60 years, 65, 70? What is it?
Yeah. So it used to be 65. It has increased stepwise to 67. And 67. Right now it is connected to the life expectancy. So, for example, there's a very helpful tool from the provider of the state pensions where you can just put in your birth date, and it will calculate your retirement age. And in my case, I'm from 1987. In my case, I think it's like 70 years and 6 months or so. So it's really been increasing quite steeply. Okay. But what is also good to know for the period of the data set, at least much of the period of the data set that we analyze, it is 65, and some up to some point 67. So it's right in between that. That's that would be
Thanks so much, Jim.
Yeah, no problem. Additionally, it's good to know that this, of course, has consequences for private voluntary pensions, which are really small in the Netherlands, which is, I think, really a consequence of the fact that state pensions and occupational pensions already provide a lot of pension income. Next to pension income, I think it is also good to know what health insurance looks like a bit in the Netherlands. So it's good to know that in terms of health insurance, there's a universal health coverage through the what we call ZVW, which basically means that the out-of-pocket health spending is quite small in the Netherlands, even at older ages. So this is really a situation that is way different from the say the American literature, where of course the Denardi type of literature, where health spending is really important. That is not so much the case in the Netherlands because there's universal coverage in this health insurance. This accounts for out-of-pocket medical spending, but also for long-term care. So there's universal coverage through the WLZ, which also means that the huge cost that many American households face at older ages, that we tend to divide this among our taxpayers, so to speak. So the out-of-pocket health spending is in that sense quite small in the Netherlands. And giving away a bit of what we find is that we simply do not find any significant health spending increases through retirement either. So this is pretty consistent with what you would expect from the institutional framework. Also good to know is that we have substantial housing wealth, and many would think, okay, this is concentrated among older people, which is definitely the case. But on average, you already see that among the group of people aged 30 to 35, that housing wealth is already substantial, with on average 100,000 euros, which increases over older age groups. Be aware that housing, of course, is very much illiquid, and that makes it, in that sense, quite comparable to our pension system, because both state pensions, occupational pensions, largely illiquid. Would be really interesting to see what happens with this lump sum, because then at the start of retirement you're taking away somewhat of this liquidity constraint, but although on average the Dutch households have a very adequate pension, it's largely illiquid. So that is something that is important to keep in mind also when we discuss some policy implications at the end. Here is some evidence of how the Dutch population is actually doing, given some administrative data on both income and wealth. And here you see that the first pillar, which is the state pension, already provides almost 18,000 euros per year, which is substantial. And of course, this is flat rate over the income distribution. And you see that the other large component is, of course, the combination of the first and the second pillar. And the second pillar are the occupational pensions, which are huge, but especially, well, not at the left bottom of the income distribution, but in general, people receive quite some income from this second pillar pension. And of course, this is definitely more at the higher end of the income distribution, because these are the people that actually worked, had a lot of income, etc. And here, this also shows you that the so-called third pillar, so the private pensions, are relatively small in the land. So it's the real small green area in the graph. And then similarly, the dark blue area shows you the income you would get from fully selling your house, so buying an annuity from your house, which is also quite substantial, but again, very, very much illiquid here. Anyway, this is good to keep in mind, because the institutional framework of the Netherlands is very specific, I guess, and might also be very much driving the results that we'll see later. Well, we're not the first who take a look at consumption over the life cycle. So one of the first papers who did this seriously, doing with randomized data, are Eduard and Hurst in 2013. They did this for US households using the CEX data. So what you see here, these are two different graphs, and I think the black line is total spending, and the excluding home services, what they call, and the other one, the dotted line, is including the home services. Anyway, I think the pattern is quite consistent. So what you see here over the life cycle is that you see that consumption tends to increase at some point, and it already decreases quite well before retirement, and even decreases further during retirement. We also see here, consistent with the consumption drop literature, of course, that when you take a look at, say, age 65, there's a bit of a bigger drop compared to the age 64 than elsewhere. But the big thing here is, okay, this is the case for the United States. From the United States, we know that on average, pension income might not be adequate. So is this preferences, or is this just a lack of resources? So we cannot disentangle the two. And I think that the Netherlands is a very interesting case to disentangle the two, because on average, we know that pensions are quite adequate. Another difference from the data that we use is that CX data is beautiful. So it has a lot of disaggregated consumption categories, even more than we have in our list sample, except that we know from CEX that this is a repeated cross-section. So this is not panel data. And what I hope to show you is that this is quite crucial, at least for our understanding in the Netherlands, whether it's within personal or within household effects, or whether you actually take the cross-section or not. In our case, we have basically different patterns that we observe. Anyway, when we take care of this, so when we actually look within households or within persons, our pattern actually matches this quite well. So I'll show you this in a minute. So we built on Eduard and Hurst, and the other interesting paper that we built on, which is very interesting as a comparison for our results and our data, is the Kalsrud and others paper. Instead of using survey data, they depend on admin data. So it's admin data. I think it's the whole universe of the Swedish population. Very interesting. It's a panel, but the main drawback is that if you do this based on administrative data, which means you have to calculate consumption from income and wealth changes, you basically only observe what happens with total consumption. So you don't have the disaggregated aspect like Eduard and Hurst had and we have. But interesting to see here is that even when you take a look at a pension system that is on average, I think, more generous than the system of the United States, here you do see that at least in retirement, you do see some drops happening, and maybe the drops itself are not that big or interesting, but you do see some development over time during retirement. And this figure actually suggests that there's not a lot of action in terms of consumption happening right before retirement, but it happens at retirement and during retirement. Although here we see that the results can also be quite heterogeneous. We did some similar heterogeneity analysis, and I'll take you through them in a couple of minutes. But the effects that we find are quite homogeneous, actually, except for maybe those who rent versus those who actually home house, and I'll come back to that in a second or two. Our contribution is, of course, then we add by simply looking at the Netherlands, so we can talk about preferences a bit more instead of having inadequate resources. We can take a look at the whole life cycle using quite high quality longitudinal data with detailed information on what we would call disaggregated consumption. And of course, this allows us to use individual fixed effects, which are very important for the actual patterns that we will observe in the data. So again, let me stress, it's the goal of the paper is absolutely not to make causal claims. So if I make a mistake in using some causal wording during the presentation, it's good to forget that, because we're actually not making any causal claims, but it's really the goal to have a comprehensive integration of these mechanisms, and especially to take a look at, okay, what could change this marginal utility of consumption over the life cycle, and especially at and during retirement. And we do a bit of this backwards induction that I mentioned, like, okay, these are our empirical results. What type of life cycle model, what aspects in this life cycle model could help explain this? So it would be very, very much appreciated if we, in a couple of minutes, think about what could drive these results, to have your input there, and to think about the ultimate, so to speak, life cycle model to explain these patterns that we observe here. Well, the data, like I mentioned, interesting data. It's from the list. Unfortunately, it's not a yearly module, but we have quite some waves, so we can actually use this within person and within household variation. And the great thing is that we also have a lot of other characteristics in the data set. Turning to the consumption categories that we have in the list, so we have about 18. Which is definitely less than, for example, in the HRS CAMS, where you have 30 plus, but only take a look at the people age 50 plus. And it's different from CEX, of course, where you have even more categories, but you don't have the panel dimension of the data. So this seems to be a somewhat of a in-between situation. So we have panel data, but not as many categories as CEX and CAMS. But at least we have 18, and it's good to know that, of course, we sum these to, if the list data didn't do that already, to the household level. It's equivalized, and of course in real terms. So it's comparable over time and between households and persons in that sense. Well, the data set, if we combine this, we have almost 33,000 household year observations, which means that we have more than 8,000 households that we can observe. Of course, this is much less than say when we would use admin data like the Swedish example, but still it allows us to do some quite simple heterogeneity analysis at least. And it's also good to know that these categories, that the number of observations might differ a bit between these categories depending on when they are surveyed, and when some waves might actually not ask all these consumption categories that we have. First of all, let me start out with some descriptives here. So here we have an APC figure of just the monthly total household spending, and you can already observe a bit of the pattern that we will find using somewhat more formal analysis. And this also matches the pattern of Aguiar and Hurst in the American situation quite well. So we do observe some cohort effects here. But interesting to see is first and foremost that there are no huge drops at the retirement age. So going from 64 to 65, the drops are not huge, which is consistent with earlier literature for the Netherlands. And what we see here is that consumption already tends to decline, say, just after the prime age. So at the age of 50, 55, you already tend to see somewhat of a decline in total monthly spending. And this is not an artifact because this is unconditional. This is also what we will observe in more formal analysis. So what we do in our more formal analysis, of course, is that we want to instead have a look at the unconditional mean of total spending and all the other categories. So that we have a conditional mean. So this means that we correct for all sorts of things we can observe and control for, gender, household characteristics. We also take into account health, marital status, whether you're a widow or not, etc. And the great thing is of course, that we can take into account these time invariant unobserved factors because of our panel data. So this also means that the cohort effects that we just saw in the descriptive figure, that we also can account for them in our analysis. When we do the more formal analysis, and like I announced a bit already is that it's quite important to whether you would take into account these fixed effects or not. So basically, here we see that the gray dots are the estimated coefficients from the full model with fixed effects, and the dark gray dots are the estimates for a model without these fixed effects. So without these fixed effects, you would almost have a flat line, meaning that not a lot is happening over time in terms of consumption, and especially not at retirement and during retirement. However, when we do control for these fixed effects, so we take a within household perspective, we do see that this matches the descriptive figure and also the results of Aguiar and Hurst actually quite well for the Netherlands. So what we see here, no huge drops at the retirement age. It tends to decline already from, say, the prime ages, the total consumption, and we do see that during retirement consumption tends to decline even further. Well, this is, of course, might be puzzling. So this why it's also good why we could decompose this in different disaggregated consumption categories, and that is what we'll do to at least try to understand what is happening here. But it's quite interesting, and this would also mean that this is quite interesting for policy too, because it has always assumed more or less the flat consumption that is optimal during retirement, but instead, and especially if this tends to reflect preferences instead of inadequate resources, this might be vastly different, and different types of payout schemes may be preferable to the flat rate annuity that is the default in many pension funds right now. So what we try to do is that we really try to
Jim,
get...
Jim, sorry, I have a quick question.
Yeah, sure.
So now you show the difference with and without fixed effects. And so it's the fixed effects that makes the difference, right? So what about if you have with and without the controls? Because, I mean, you have a lot of controls, and some of those, well, of course, I know that is not causal and stuff, but some are also like, the explanations that are given in the literature sometimes for the consumption drop. So
Right. Good point. So we tried this with several empirical specifications. So first of all, including, excluding observables, given the inclusion or exclusion, including or excluding fixed effects. Actually, the pattern that really stands out is that once you control for fixed effects, you see this declining pattern, regardless of whether you would take into account the observables or not. Does that answer your question? Yeah. Okay. Great.
Yes.
Good question. So what I will do here is these are all results with the control variables, and I'll focus on the specification with the control variables and the fixed effects, but be aware of the fact that this is actually quite robust, except for if we exclude these fixed effects. Well, what we try to do is, of course, to really make sure that we're kind of measuring the revealed preferences here, and not so much the potential inadequacy of resources. So, of course, we have some auxiliary information from prior papers, but in the list there is also some interesting data that could really support this view of that we're actually measuring revealed preferences instead of inadequate resources. Namely, of course, we have income. So here we do exactly the same, but then we use monthly household net income. And I think that the confidence intervals become a bit large at the end of the life cycle, but at least we find absolutely no evidence for the fact that income really tends to decrease at retirement, during retirement. So this gives us some support, at least, for really thinking that the consumption patterns that we observe, that they're more preference related than that they're inadequacy related. And there's another interesting check for that. So one of the perks, of course, of survey data is that there's also some subjective information. So in the list data, there's also information on the extent to which people think they can make ends meet easily or not. So here we made this binary, in the sense that okay, people tend to respond that they can make ends meet well, or they cannot make ends meet well. This is on the y-axis we see the probability of problems making ends meet. And what we see here over the life cycle is that if we observe anything, then it would be that those in retirement tend to have fewer problems making ends meet than those earlier in the life cycle. Again, this is very much dependent on whether you would take into account fixed effects or not, but at least it gives us some idea of that the consumption pattern that we estimate, that this really is at least more preference driven than inadequacy driven. But we can start looking at the disaggregation of the consumption categories, and let's start by, well, maybe the least surprising or least interesting and the most mechanical one, which is the amortization channel. So when we take a look at the mortgages, I think this very much, or this is one of the key drivers, I think, of our results, because here you clearly see that mortgages really resemble the pattern of total spending. This is a lot of euros compared to the actual total, and here we see that over the life cycle, spending on mortgages tend to decrease. This already happens right before retirement, but also through retirement, and this is really to do with the fact that there are, at least for most households, mandatory repayments in these mortgages. So this is a very mechanical mechanism, I would say, that would drive the result. Still interesting to see, because not everybody has mortgages, of course. So there's quite the discrepancy between those who own a home and those who rent. So we can also take a look at what would the results look like if you pay rent, and we see a totally different pattern here. So instead of seeing this or observing this decline over the life cycle, we actually see a quite constant pattern. And if you're willing to look through the statistical confidence intervals, then you would even see that among older people that they tend to have pay higher rents. So this is definitely different for homeowners versus people who rent. So the picture that I sketched with total consumption, we of course can have a look at what does this mean for homeowners and what does this mean for renters. So we do see that when we separate the two, that clearly for homeowners we have a pattern that is very much consistent to the average I showed you before. However, when we take a look at the renters, you also see a similar pattern, although it is somewhat more condensed. So even for the case of households that rent, they also tend to have this decrease in spending during retirement, not the huge drop at retirement, and the gradual decline already prior to retirement, although this is all somewhat smaller compared to homeowners. So this means that there should also be different drivers of why, especially renters, might decrease their consumption spending. So we take a further look at what can explain this pattern. And one of the most interesting parts, I think, is to take a look at what we call consumption leisure interaction. So is there some kind of non-separability between consumption and leisure, of, if you'd like to put it otherwise, consumption and working hours, for example. And one of the main examples also in the literature is, of course, clothing. So, for example, people spend quite some money on clothing throughout their working career, but as soon as they retire, they don't need the jacket and the tie anymore, and so they spend a lot less on clothing. Well, this is absolutely what we see here. So there tends to be some non-separability between consumption or spending on clothing and leisure time. So here we see that clothes actually match the pattern quite well of total consumption. But again, we don't see a lot of action at retirement, but we do see the gradual decline further in retirement. So there definitely tends to be some of this interaction between consumption and leisure, and you do have that for potentially a lot more spending categories. So another one that is also quite mechanical, I would say, is transport. So this includes commuting. Here we clearly see a pattern that is consistent with transport and leisure being actual substitutes. Again, this matches the pattern of total consumption quite well. We don't see the drop at retirement. We do see the gradual decline prior to retirement and especially after retirement. But there are some other categories that might be related to leisure, and this is an interesting one where we receive quite some questions about. So how can we explain the fact that even when we take a look at spending on holidays, that this matches this overall pattern quite well, and we see that people, especially during their retirement, tend to spend less on holidays. And I think that the main explanation is, I think, all the people in cars and caravans that you see on the European speedways during summer holidays. Namely, I do think that people, whenever they get older, maybe they might not reduce the number of times that they go on a trip, but they just go on different trips. So they might buy this RV or caravan and go to the south of France instead of taking an airplane to, I don't know, across the pond. At least this is something that we observe in the Netherlands, that even holidays, spending on holidays tend to decline. So again, this is something that is related to leisure, but it's you would a priori maybe expect that the more leisure time would lead to more spending on holidays. Well, the actual truth is tends to be different in the data.
Jim, sorry, I have a bit of a delayed question.
Yeah, sure.
It was about the owners and the renter. So what you're showing here are kind of absolute changes, right?
Yeah.
So
Yeah.
because I find it a bit difficult to compare like the owners and the renters,
Right.
because like it's different like in absolute terms, but maybe the renters, I guess, we are less wealthier. So I don't know
That's
what
right.
is than the owners. So maybe it's not in
that's a
relative
good
terms,
point.
maybe it would be actually not like that.
No, so what we see, and I think we tried different specifications, and this is in absolute euros, of course. We also took logs on euros, for example, so that you actually measure more the change in the percentage change in spending. And I think that at least the patterns are quite similar, if I remember correctly. So by heart, I cannot tell you whether homeowners and renters, whether the difference is more condensed or more widespread. At least for both, it means that still the drop in, or the gradual decline in consumption is observed among both of them. So
no, indeed, I think for most graphs it doesn't matter, right? But just when you compare, when in graph like this, when you compare to different groups, like the homeowners and the renters, maybe they have different, initial level of consumptions, and so in relative terms, so we don't know.
Yeah, very good point. Yeah. So another one.
Just to jump in. Just also for holidays, because this is self-reported data, right, in the survey.
It's self-reported,
so,
absolutely.
How do they ask them to report the holiday? Do they ask them about the total, I don't know, price of the holiday? So that might already include the travel already, right?
Yeah, that's a good point. So here, and that is also good to mention, this is in a sense not diary data, but it's recall data.
Yeah.
So basically what they ask people is, how much did you spend on X in the last 30 days? So there might definitely be a bias in it. And I think the one thing that you mentioned that would be absolutely great to have is, of course, have a price versus quantity. But here we just cannot separate the two, unfortunately.
No, but this might be, this might be including the plane rides,
Absolutely.
in there.
It
so
does.
Then in that sense, it is similar. So
But in terms of price and quantity, I would say that at least my premise would be that quantity does not decline, but it's just the price per trip that might decline for those at older ages. That is what I think.
More luxury travel.
Right.
Yeah.
Right.
Yeah.
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 Yeah. Thanks a lot. We don't see a lot of things happening with other leisure activities, but then again, this is very imprecisely measured. At least we don't see any huge increases, meaning that leisure activities and leisure itself do not tend to be complements here, but they don't tend to be substitutes here either. But then again, okay, this is very imprecisely estimated in the data. Another interesting one, because you'd expect that people tend to stay a lot more at home. So what happens with their utilities? And even there, we find that there's a decline in utilities. And one of the main reasons for that is that, first of all, people tend to, at least that is what we hope, but there's also a lot of discussion on whether this is sufficient or not, whether people move from bigger homes to smaller homes. But interesting here is also to see, of course, that again, this gradual decline in utilities already starts at, say, age 45, 49. So it might also be related to all the kids leaving the lights on and taking half an hour showers, maybe. So I'm not sure about that, but at least it matches the overall pattern that we observe. Cleaning and gardening is different. This might be related to home production, of course. You have a lot more time to do stuff like this. And we see that increasing. But then again, also take a look at the y-axis in terms of the total consumption. This is not huge. Still interesting to see that there tends to be some complementarities between leisure and cleaning and gardening, consistent, of course, with what we would expect from Becker's theory. Although, and we took a look at that prior, is that we don't see a lot of substitution, for example, between time spent on it and actually money spent on it. Anyway, interesting to see a different pattern emerging here. Then, of course, we have the food intake, both inside and outside. Again, this matches the patterns quite well. Again, food outside is quite imprecisely estimated, but again, we do see that if you have more leisure time, it's not the case in the Netherlands that people go out for food a lot more. So there does not tend to be a complement there. Let's move on to some other interesting transitions, maybe that might be household transitions. So then again, do not interpret these as fully causal. But here we see, of course, some very expected patterns, like with daycare. Okay, at the end of the life cycle, you don't see a lot of things happening, but there are certain drops in daycare, especially midlife cycle, when kids turn the age that they don't need to care the daycare anymore, go to school, etc. So this is just as a check that we at least have some observe some patterns that definitely make sense. The same goes for alimony. So apparently people start divorcing from the age of 40 on until, say, 55. Anyway, this is quite imprecisely estimated. We don't want to draw too many conclusions upon this. Health might be really interesting here. So this is what we discussed before. So it's good to keep in mind the fact that there's universal healthcare coverage, and we don't see a lot of things happening with out-of-pocket medical spending here, and especially not when you take into account these either fixed effects or not. So you see in the dark gray estimates, you do see some slight increases, of course, but these are not really statistically significant. So I would say that this, at least it does not match the pattern of total consumption, but it doesn't support the idea that medical expenses increase incredibly over the life cycle in the Netherlands. So that's good to keep in mind, the institutional framework as well. We don't see any other health type behaviors, although this is again very imprecisely estimated. We have some others that might be interesting, but more from a household portfolio perspective, household finance perspective. So we see expenses on debt decreasing, all consistent with the total spending pattern, insurances, etc., personal care. We see donations decreasing. So this also includes donations, for example, to churches, but also donations to neighbors, grandkids, etc. But we don't see huge declines here during retirement, at least not statistically significant. Schooling might be a very special artifact here anyway. We don't see a lot of things happening here. And the thing here is that what I would really like to discuss with you is, of course, okay, these are the patterns that we've been seeing in the data. So we have total consumption, which declines from the age of 50 already. And many of these spending categories are quite consistent with that. So what we try to do is to do this backwards induction a bit and having a look at the life cycle model and what types of features should be in this life cycle model to actually explain what we observe in the empirics. So far, we've been trying to see whether we could work with non-separable consumption and leisure. So we saw that there's these mechanics between consumption and leisure that can either be complementary or more of a substitute. Anyway, you might want to take a look at whether the marginal utility of consumption actually depends on work or leisure hours. And I think we have some empirical evidence for that. The marginal utility might also be very much age and health dependent. So that would definitely be a component that we would like to add to this life cycle model. The least interesting, and the most mechanical one is, of course, the mortgage amortization. So this is not really a preference because it is simply required by the bank. Anyway, it's good to model this, I think, in the life cycle model. And of course, what we discussed before is that pensions, including potential housing wealth, are largely illiquid. So I think what people could really gain from different payout schemes is that this would at least partially solve a bit of the liquidity constraint. So if we take our empirical results as a fact that this is preference driven instead of resource driven, then people would have a preference for spending a bit more at retirement than later in retirement. So this means that at the beginning of retirement, they're quite more liquidity constrained than somewhat more at the end of retirement. While at the same time, we know that pensions are illiquid and hence people are liquidity constrained. So I think that if we think about policy alternatives for pension funds that at least decrease somewhat of this liquidity constraint, and whether that is a high-low annuity or whether that might be the lump sum, this might be actually welfare improving for many of these households who show these types of preferences. So with a very simple sketch, I try to do this and have some policy counterfactuals in a very simple deterministic calibration of the welfare effects. So let me turn to these figures, and here it basically shows you what it means to have four different scenarios. So we have what we have currently is a flat real annuity, but you can also work with a high-low annuity. Instead of a high-low annuity, you could also work with the idea of policy to work with a 10% lump sum and then flat real after that. And there's also a lot of discussion about that. Shouldn't we just only assume a nominal flat pension annuity, meaning that if you have inflation, then automatically you'd have a real high-low annuity path. Anyway, here you would see what this would look like in terms of income in the top figure. In the bottom figure, this would show you what happens with total spending. So here in the total spending figure, you could really clearly see that other options like the high-low, but also the 10% lump sum, make sure that at the age 65, 66, that you have a lot more income available for the consumption that you'd like to do. So you're less liquidity constrained than later on in retirement. And this, of course, matches the consumption preferences that we just saw. So when you take a look at the welfare gains, and these don't look too much at these figures. So it's good to mention that this is fully deterministic. So welfare effects are really small. But it's good to have a comparison. So compared to a real flat rate annuity, you could have a welfare gain by simply having a high-low real annuity that matches this average pattern that we just saw of total consumption. But interestingly is that there's, of course, a lot of discussion about this 10% lump sum at retirement. The cool thing here is that when we put this in this very simple calibration, it actually gives you the same positive welfare effects, the welfare gains, as a high-low real annuity. So it can actually mimic the high-low real annuity. Of course, there's lots to say about whether the 10% lump sum is a good idea, but at least from this perspective, it could give you the same welfare gains as the high-low real annuity, plus, and then assuming that the interest rate is about 2% and consistent, a nominally flat, so real declining annuity rate can also match these. So these are all preferred to the current real flat rate annuity that most pension funds have, and especially have as a baseline. So that would be interesting to investigate a bit further, also especially with what happens when we introduce somewhat more stochastic elements. But at least this is interesting to see for policy, I guess. And because of the fact that it's fully deterministic, you could basically see this as most likely as a lower bound, and this actually measures what would you gain from solving a bit of this liquidity constraint that you have at retirement, given the preferences for spending. Well, coming to the conclusion, so what we see here is that consumption increases at the beginning of the life cycle, stabilizes, then starts declining. We argue that this pattern is first and foremost preference driven and not so much adequacy driven. We see that there are quite some categories that really contribute to this very to this pattern, especially the mortgages, utilities, transport, food, holidays, clothing, etc. So right now we're really thinking about, okay, how should we put this these results in a policy perspective? And I think this could really be interesting for having the discussion about the ideas of having this lump sum takeout at retirement. Of course, given all sorts of potential negatives, like do people understand this? Don't they overuse this? What happens when life expectancy is not deterministic, but is actually stochastic, etc. Anyway, it would be good to have a bit of discussion on this. Thanks a lot for your attention, and I think this is it from my part.
Thanks a lot, Jim, for this very interesting presentation. So are there any questions? I think we have time for one or maybe two, maximum two short ones. Otherwise, I have a question, so then I will take it.
Feel free.
Because at a certain point, and I think this is, I mean, just going back to my initial question a little bit, right? So because when you had this slide, just before you did the calibration, so okay, what could explain this? And and that is a little bit what it was in the back of my mind when I asked the question, because for example, here you talk about health, no? But you do control for health, your models, and also like when you were explaining some of the graphs, for example, you say this could be like the children, but you do control for the number of children. So I was a little bit kind of after. So like where you're not already included, some of these explanations.
Gotcha. Yeah. So if I have time, I can show you some of the appendices that we attach. So here you see basically the full estimation results. So we have lots of information in it, including number of children, but also marital status, health, etc., income, whether you're a homeowner or not. So there's a lot of a background in it, and I think there's a bit of an optimum there, because you don't want to have everything in it because of, some things might be very endogenous. On the other hand, the question that we receive, for example, from the pension fund, is all about these types of issues, like, what happens when people move from as a homeowner to renting? What happens when people divorce? What if that happens when they're widowed, etc.? So at least for the policy design, these background characteristics are really interesting because they can, well, communicate what people should do or give some financial advice in that sense, and they're really looking after that.
So I can imagine maybe it would be nice to show what happens, you know, when you add them, right? So what is the contribution of each one of these? Because then, you know, you would be kind of disentangle what is driving what, right?
Good point. Yeah.
Okay, but I think it's 3 o'clock, so we have to close here. But thank you very much for your presentation, and thanks everybody for participating. And we're going to see. I hope to see you all again in June for the next seminar. Thank you very much.
Thanks a lot for joining. Bye bye.
Bye bye.